COVID-19 and everything it's done to not just our economy, but also just the logistics of getting things done, put a ton of strain on the mortgage industry, as it did, I'm sure, every industry. And I wanted to, we spent a lot of time actually as a company thinking about different ways to navigate through it. And I think we did a really good job. So I'm happy to share some of the stuff that we did to get through it. There we go. So this is a little bit about me. I co-founded McKay Mortgage in April 2017. And as you alluded to, actually with my mom, Tina McKay, we are business partners as well. And we have Matt Lindy, who's our office manager. And Diane Cook is one of our loan officers, and John Laux is one of our newest hires. So it's 5 of us, and we are, a definitely small, mean, and lean company with not a lot of people, but a lot of expertise that can seem like a bigger company than sometimes it is. Since we became a brokerage in 2017, we funded $157 million in mortgages. In 2019, I was the #2 mortgage broker in Maryland and number 66 in the country, and I'm part of the MMVBA and the Bethesda Chamber of Commerce. And our business model is keeping our margins as lean as possible and our expenses down, so that we're able to offer competitive products and move as quickly as possible. All of our business is referral based, and we don't do a lot of online marketing or advertising or paid relationships or anything like that. So that's a little bit about us. Starting at the last week of February, the cases of COVID started spreading aggressively outside of China, and you saw an aggressive reaction in the global markets. And for a quick synopsis, when you see the stock market crash, it oftentimes means that interest rates are dropping drastically. The stock market goes down, people move their money to bonds, which are secure, and when the value of bonds goes up, interest rates go down. And that creates opportunities where people are refinancing their current mortgages very aggressively. So we're sitting in a situation the last week of February and the first week of March, where interest rates are at historic lows, as low as essentially they've ever been. We had a pipeline of 78 loans and $38 million in volume, and the whole world is shutting down. And to give you some perspective, in 2018, our company closed $18 million in volume in the entire year. So we were like, what the hell are we supposed to do with all this? So once I saw that people were starting to quarantine and things were starting to slowly shut down, and I figured that would continue to escalate. I spent the better part of a day just thinking about all the problems that I thought had a reasonable chance of happening. And how I could start getting ahead of them. I had to take the next day off because I was pretty depressed after all day thinking about problems all day long. But it was a really helpful exercise, and I think you'll see some of the things that we implemented were pretty successful. We definitely spent some time thinking about things that didn't happen, but that's okay. And I know this is pretty granular as far as the mortgage industry is concerned, but a lot of things that I learn are I can take things away from other industries, and hopefully that's similar for some of you guys. And I didn't come up with all these problems myself. One of the first things I did also during that day was call every person in the industry that I respected and ask them what they thought was going to happen. So the first biggest problem we had was pipeline management. We suddenly have this massive pipeline. We have been extremely busy the last year and a half, but this was kind of beyond any of that. Having 78 loans in process was it double and probably close to triple of the amount of loans in process that we had ever had before. So not only communicating to all those clients, but just capacity. Can we get these done? When you start a loan, it is locked for a certain period of time, 30, 45, or 60 days. And if you don't close within that time, it can be problematic. I worried about courthouse closures, which it could have a number of different impacts on closing a mortgage, depending on your jurisdiction and whether it's a purchase transaction or refinance. Documents need to be recorded at the courthouse afterwards, but even prior to that, you have to do lien searches to make sure there's no outstanding liens on a home before a new mortgage takes over, and all sorts of weird stuff like that, and making sure that somebody doesn't have a bunch of judgments and they're not being sued by the whole world. Things like that would be problematic for a mortgage closing. And And if the courthouse closes, what the hell is going to happen there? Delays in underwriting with rates at a historic low. We weren't the only ones with a lot of business. All these lenders that we do business with were suddenly flooded, and they didn't necessarily have the capacity to close this amount of business either, or at least in a organized fashion. But on top of that, they were starting to move their employees to work from home, and not all these companies are that nimble. Some of them, fortunately, have already a lot of employees working from home, but that was a problem that I was worried about. Appraiser availability, once again, not only a volume issue, but are people going to be comfortable letting appraisers come into their homes? Are appraisers going to be comfortable going out into the world? So you might have an issue where there's a massive amount of demand for appraisals, and you would be a problem in and of itself, but then you might have less appraisers than you normally have to work with, and then clients having not wanting them to come in, and then ancillary process slowing. There are a million moving pieces to every mortgage closing and purchase transaction, and stuff that you could do 10 mortgages and you wouldn't really know are actually happening. Personal, you could refinance yourself 10 times and you never really deal with the stuff. But we have to order loan payoffs for your old loan. And even when a home is bought or sold, the seller needs to get a loan payoff for their loan. And I just expected that to slow. The same lenders that are busy with all this new business are the same ones that need to process payoffs and might not be in a hurry to do so. It's a low priority item for them to begin with. So I thought that'd be problematic. And then you have to get updates to homeowners insurance policies on these homes. And I just expected their industry to slow like everybody else. I thought every loan that closes, you have to verify the borrower's employment to make sure they're actually still employed at the time of closing. Usually it's done 10 days prior to closing, and I just thought that could be difficult as all these companies are in disarray. And obviously people losing their jobs is a very straightforward one, but just companies being in disarray, it can be tough to get in touch with somebody at that company to verify somebody's employment. And then credit lines freezing. So whether it's business lines of credit or home equity lines of credit, in 2008, that was one of the first things the banks did was freeze access to liquid loans like that. So I thought that might happen as well. So then we started thinking solutions. As far as pipeline management, the first thing that we decided to do is over communicate to our clients. We are very active about communicating to our clients during the process, but we were going to go overboard because everything we were going to be talking about fell outside the realm of what we're usually talking to people about. So the first thing we did was send out an email to every single client in process saying, this is what's going on, and this is what we think might happen. Here are things that we can do to control it. And really it was, when we ask you for something, get it to us immediately, because you can control how quickly you move. And I know I can close your loan today, but I don't know if I can close it tomorrow. So if this is important to you, you need to make it a priority. As far as our volume capacity, we hired John Laux, who I mentioned earlier. He had someone I had been talking to, and we were suddenly in need of labor that he could do immediately and take a lot off our plates that he did not need a ton of training to do. So we brought him on immediately at a pretty high hourly rate. And it's worked out extremely well. John is now with us full time and evolving into a lot of different roles, but let's hire people and we have plenty of business coming in. Don't be short on payroll expenses. Courthouse closures. This was something I kind of decided there really wasn't much I could do about other than lobby. Fortunately, in Maryland, DC, and not Virginia, but in Maryland and DC, even if the courthouse, I started calling title attorneys. Even if the courthouses did close, it really shouldn't hold up most of the transactions. A lot of it can already be done electronically. Virginia was a little more problematic, and the courthouses did close in Virginia, but they kept open the parts that do, a deed recording. So it ended up not being a problem. But I did start lobbying for eNotary implementation, which is a technology that already exists, but everyone's been slow to implement, which I think is a common thread throughout the entire world. Even Zoom, we're on right now, is something that's existed for a while and probably should have been used more than it is. Closings, it is possible to do them electronically. You can't do them over Zoom. There's specialty software. But I started bugging the hell out of every lender that I worked with to start getting this stuff in place now. They are. I don't think I'm the reason they are, but I was screaming at the sky for a while on that one. And really, that was really more to solve the logistical issue of people closing, because you still do have to do the closing in person, sign the paperwork with a notary in front of you. And that still really is happening right now, but it hasn't been as much of a problem as I thought it was going to be. First of all, the notaries are being incredibly careful, and all due precaution and more than due precaution is being taken. And then people are getting creative. Most of the closings are taking place outside, whether it's on a patio or an empty park bench. Or I had one client, it was raining, so they set up a table in their garage and opened up the door. So it really hasn't been nearly as much of an issue as I expected it to be. So that was a pleasant surprise. Delays in underwriting and low loan file processing. So this absolutely happened and is still happening. If anyone out there is trying to refinance, you might be frustrated about how long it is taking, and it's not your loan officer's fault. Rates are still incredibly low, and every lender is backed up very much. So how are we going to handle it? I mean, properly setting our clients' expectations. In a normal environment, you can close a refinance in 3 to 4 weeks, and you'd lock for 30 days. And I just explained to them that's not going to happen. And it's not news to them. They know what's going on in the world. It's not shocking that things are going to take a little bit longer. So I explained to them it's going to take 5 to 6 weeks, and some of them I told them it was going to take 2 months, and they're totally fine with that. And it's not like they're doing stuff every day, which I explained to them. They're just sitting around waiting, but we lock for long enough and they're protected. So just let them know that's going to happen up front. And we're locking for longer than necessary. And then, so there's 2 sides of my business: purchase transactions, so somebody buying a new home needs to borrow money, and then refinancing. They already own a home and essentially want to own it for cheaper and pay less interest on it. On the refinances, if they take a while, it's okay. They are in the home. The sooner you close, the sooner they save money, but it's not the end of the world. So it's okay if those take a little bit longer. But purchases, it's not. There are many other people involved, not just realtors, but the people who are selling the home. My buyers might have a lease that's ending. And sometimes it's 3 or 4 transactions after one. The seller is buying another home, and that person's buying another home, and on it goes. So they're very time consuming. So we would prioritize purchases and make sure they were going to lenders that were still moving extremely quickly, even if it mean that lenders' rates were not as competitive. And we can control that to a degree with our margins. And if we did a purchase for next to nothing, or did it for free in some cases, just to get it done and keep people happy, that's what we did. And keep those relationships that we have with our realtor partners and stuff like that going. That has a lot of value to us. And frankly, we're making plenty of money on the refinances. We're not at this moment. We can do that, and it's kind of an attitude that we always have. It's just get the deal done. So that it went into overdrive in that during this environment, and still is. We're still doing that with purchases. Let's see here. Appraisal availability. This ended up not being nearly as much of a problem as I thought it was going to be. I do believe it is in some areas of the country. We have more than enough appraisers in this area. We did initially react by paying for rush fees. So you can pay extra to another $200 for an appraisal to get it done faster and prioritized. That was something we did for a couple of weeks before we realized it just simply wasn't necessary. So wasted a little bit of money, but not the end of the world. As far as ancillary processes slowing, hiring John Louts was a big part of this. Ordering payoffs and homeowners insurance updates immediately. Normally, if in a normal environment, it really doesn't make sense to order a loan payoff right away. That somebody might make another mortgage payment after it's done, after you've ordered it, and then you just have to get a new one. But if we thought that these processes would slow, and they did, getting a loan payoff with some companies, this is normally something that should happen either immediately or within 24 hours. With some companies, right now it's happening 10 to 14 days. And if you wait until a week before closing, you might have to push back closing over getting a payoff, which is not an acceptable situation. So we ordered a payoff on literally every single loan we had in process. And if we had trouble getting a second payoff, before closing, we have the option of closing with the old one, which it's not ideal, but it's not the end of the world. All it means is that the loan we're paying off will be overfunded, and we'll be collecting too much money for it. And then a month or two later, the client will get a check in the mail for the difference. You'd obviously rather it be, seamless and lined up, but having options, even if they're not perfect, is better than not being able to do it at all. And that's what we were looking at. And same with the homeowner's insurance, just get it done right now while we can. Employment verification ended up becoming a major problem, but for a very different reason than I thought it was going to be. What ended up happening was lenders, understandably, it made complete sense once I saw what they were doing. Normally, anytime you get a mortgage, the lender, even if you probably don't even know it's happening most of the time, they're going to call someone in HR or there's third-party verification sites, with the most popular one's called theworknumber.com, that most medium to large companies are on board with, or something similar. And you go on there and you can electronically verify people's employment with a document that you've already signed during the mortgage process, giving them permission to do so. Typically, they'll do that anytime within 10 days prior to closing. And from a risk standpoint, that's, you're good. It's unlikely someone's going to lose their job within 10 days. That is not true right now. Sadly, so many people in this country are losing their jobs every single day. And from a cold reality perspective for the lender, they need to make sure that they are going to, payments are going to be getting made on this loan, and it's being made on the basis of your employment. So in this environment, lenders are oftentimes not using the online verification sites at all, unless they can verify they've been updated within the last day or two, sometimes not even that. Or they need to verify employment with someone at the company, a lot of times within 2 days of closing, but some lenders it's been the day of closing, which logistically can be problematic, and a lot of lenders and brokers had issues with this. But because we got ahead of things and we were asking for all of our borrowers got an email as soon as we realized the other reason we thought it might be a problem, and said, hey, we need direct contact information for your supervisor, preferably, so that they can verify your employment, and here's why, so that we could streamline it. And it became incredibly valuable for us during this, because if you wait, sometimes it took a couple days and the borrower would say, oh, well, we have this protocol and this and that, and you know, the protocol is not good enough. Oh, but it is. And then we'd say, look, we have federal employees, I have members of the military, and every major corporation you've heard of, and they're getting me direct, like, just ask. There's no rules in a pandemic. Your employer is going to understand, and any way they can help their employees right now, including closing on their mortgage, they're going to bend the rules a little bit to do so. So on every file and process, we already had name, contact information, email address for a direct supervisor that we could immediately send to the person at the lender that was verifying employment. And we didn't have a single closing get delayed because of employment verification, which we were a complete albatross in our industry for that. And I'm pretty proud of that. So that went extremely, extremely well. Lenders dissolving mid-process. I forgot to add to the previous slide, but that was something we started to worry about. When I was in the industry in 2008, that started happening. I worked at a lender that went poof overnight. It was the 7th biggest non-bank lender in the country. And within a week, it went from not funding loans to out of business entirely. So we started considering moving our loans in process to lenders that were backed by banks. We ended up not doing this. It was something we consistently kept our eye on, and were very aware of. And there were lenders that did go out of business or stop lending, but they weren't the types of lenders that we were working with. They were doing products that were a little on the fringes, which is not our business model. But we continue to monitor it, and that appears to have stabilized. It's not an active concern of ours. As far as credit lines freezing, sometimes clients have home equity lines of credits on their home, and where in some circumstances we might advise they close them, we were less likely to do so now because we weren't sure if they'd be able to reopen it after closing or not. So that was a change that we made on that as well. And those are the expected problems. There were plenty of unexpected problems that came up. Liquidity issues in the mortgage secondary market. And what this means is that you started to have issues, and there's still some issues with this for sure, but when people lose their jobs, they're unable to make mortgage payments, or when they're furloughed, or when their pay is decreased drastically, or if they're self-employed and the business stops coming in. So the federal government released the CARES Act, and the big part of that, a couple of big parts of that, but for mortgages was that all lenders had to give forbearance to all their borrowers, active borrowers. And what that means is that you're essentially allowed to call up and put your mortgage on pause. You have to attest to financial hardship, but in a normal environment, 1/4% of the mortgages in the country that people are paying on are in forbearance. 1/4%. As of last week, it was 8.5%. So it's a huge number. So what's happening is that causes first these companies that are also offering loans to be having internal problems with liquidity. Money's not coming in, but also normal market indicators. You can follow like the Treasury bill and bond prices, as I alluded to earlier, typically drive interest rates. But if the servicing portfolio is not worth as much because people are not making mortgage payments, so mortgages after they close are bundled up into mortgage-backed securities, and companies buy them as investments essentially. And if those are not worth as much because people are not making their mortgage payments, that will have an impact on mortgage rates. No matter what the bond prices say mortgage rates should be at. And this was very confusing to clients. The news says rates keep dropping. The Fed dropped the interest rate to 0. So I had to get educated quickly. What I just said, not a chance I would have been capable of explaining that in the limited amount that I did 3 months ago. So I had to get educated to explain this to people so they felt comfortable and they knew how to act, in an educated manner. And just same thing, available interest rates not in line with market indicators. Disappearance of mortgage programs from the market. This, we were fortunate, did not impact my business specifically. It did impact a number of other lenders and mortgage brokers. There were some borrowers in process that it would have impacted if I didn't start sooner. So basically, we need to rush on the closing. The lenders are still offering to continue lending on this particular situation, but they might not tomorrow. And tightening of lending guidelines, it's really it's similar to the one above. A lot of medium credit score programs have tightened or gone away. So I established a relationship with a credit restoration partner. So people that I had in process that fit that situation, I was still able to close because we moved their timelines up. But new people coming along, I started a process for getting their credit where it needed to be in this environment. And then inaccuracies in available mortgage-related information. So I alluded to it earlier, when the Fed dropped interest rates to 0, that is not mortgage interest rates. It's the rates that banks lend money to each other at, which has impacts on short-term loans and things like that. Trickle-down effect on mortgage rates, but in this environment, it really had little impact on it at all. And then also on mortgage forbearance, what I just explained, it was put out there as, oh, you can pause your mortgage payments, free pass. A lot of people were doing it without knowing all the repercussions on it. So I put a lot of effort into educating people on that, and I still am. The mortgage payments, you do have to pay them back eventually. Sometimes as soon as you come out of forbearance, 3 or 4 months later, you pay all 4 payments. Sometimes it's smoothed out over 12 months. Sometimes it's kicked to the end. But there are repercussions. I might not be able to refinance that loan later. It will show up on your credit report. So I've done a couple webinars. My county, I'm in Montgomery County, our local county councilman has a monthly town hall meeting. He invited me to come on to talk to people about, and then a nonprofit that does financial literacy. And this website down here, forbearancereport.com, is an awesome resource that a mortgage broker in California made on all that stuff. So I've just been trying to get that information out as much as possible to educate people. So that's really how we've been dealing with a lot of it. And those are my beautiful children, George and Helen, that I end every presentation with. So yeah, I don't know if there were questions or, but yeah, that's all I got.
So is it a buyer's or a seller's market, Brendan, right now?
It depends on your price range. And I don't know where everybody is, but in the DC metro area, if it's at 500,000 or below, it is still a very competitive, meaning probably more of a seller's. It's come back a little bit, but like you're still seeing multiple offers. On the higher price range stuff, especially anything approaching $1 million or over $1 million, that market is 1,000% a buyer's market. Those homes are not moving right now. I mean, my logic behind it is the more money you have, the more options you have, and if you don't need to move right now, you're not doing it. And frankly, a lot of those clients are probably on average older, and may have more concerns about like going into a home and doing something like that, even with precaution. And if they don't need to do it, they're not going to. Where at the lower price ranges or medium price ranges, like your move may be driven more by life events than convenience, I guess. So.
Yeah, and you had touched on this a little bit, but as far as, because people might not have as much financial stability right now, is this, in general, you can speak to maybe the industry overall or specifically to McKay, but have you found that has influenced how you handle people looking to apply, or your current, clients, with the financial market being as, I guess, unstable as it is?
Right. So yeah, 100%. First, I asked a question that I wouldn't typically ask people: how stable is your job? If most of the time, if somebody's buying a house, I reasonably assume that their job is, at least they think it's pretty stable. So even if it's not, they're going to tell me it is. But that question has a very different undertone right now. So we might have conversations about that that we wouldn't have normally, and just say, okay, that's great. You need to keep me informed. A lot of companies are doing, like, cutting their entire, everybody's taking a 10% pay cut. And that's something I need to know about, because if I know in advance, I can anticipate the problem and things like that. Initially, I was, whether given all the instability, whether they should actually buy or not in this market is really more of a conversation they need to be having with a realtor. But if they would ask me, I would have the conversation with them. And, there were certain points of time earlier in this where frankly, if I were in their shoes, I would not be buying a home right now. And I would tell them that, I just think times of uncertainty are not when you should be making large financial commitments. I do think things have come back a little bit from that. I haven't had anyone ask me that question in a while, so I don't know exactly how I'd answer. But as far as the programs moving in and out, yeah, absolutely. There's still some volatility in some programs that I am doing where, so I have 30 different lenders I can do loans with. And there's certain programs that maybe usually all 30 would offer, but now only 2 are. And I can still do them with those 2, but if I'm doing that loan, I'm going to explain to those clients, look, it should be 30 and there's only 2. That tells us that, like, I can get this done, and I wouldn't move forward if I didn't think I could get this done, but like, we are not on as firm ground as we would be normally, which on a purchase transaction I need to be transparent about, so everybody does know what's going on, and we proceed with caution and then move as quickly as freaking possibly.
I think that's a fair point. I mean, something I think that McKay Offices has also tried to really do is just be over communicative with our members in this time, because things are changing so much.
I get the emails.
So it's been interesting to see how you've approached problems that you did anticipate, problems that you might not have anticipated. So I guess my next question would be, do you find that there are some things, like some infrastructure things that, I mean, I don't want to say that this is like the COVID outbreak is a positive experience, but have you found that with this whole experience, this has put light to some of maybe the things that needed attention in your company, and that have changed for the better? Or do you think that your company is going to come out a little bit differently because of the things, the challenges maybe that you've had to approach? And just if you wanted to touch on a little bit about that at all.
Yeah, 100%. We are definitely a better company than we were 3 months ago. Not just, I mean, we're doing a lot of business, but from a process standpoint, we had to get streamlined quickly. And John, who I've mentioned a couple of times, was a very big part of that. And as far as templates, like, I mean, just basic stuff. Like, I have, an email that I probably send out 5 times a day that I would type out every single time. So I operate a lot more efficiently from that capacity. Zoom is something that I use as part of my process with clients now. When we were first starting, I would meet almost every client face to face, and I would go to every closing. And I would still like to go to as many closings as possible when all this is over, but meeting face to face initially became impossible for me last year. So we would do, reviewing figures over the phone. And now I literally have Zoom, my process is I have the initial conversation with them, get on the same page, find out what they're looking for, et cetera. I run figures, I send them to them. Previously we review them over the phone. Now we do it over Zoom. It's 1,000 times better. It has some of the face-to-face aspect, but I can guide them through the figures, and it's 1,000,000 times better. And my calendar has become so busy. I had to rely on Calendly, which is an awesome tool where I can just send someone a link and it syncs with my calendar and they can see what times are available and book it, and it happens automatically, as opposed to playing this scheduling dance where I'm like, here are the times I'm available for the next 3 days. Let me know what works, which is not only clunky to type out and look at my calendar every time, but back and forth. And then I have, told 4 people to schedule with me during this window out at a time, and they start double booking on top of each other. So we are drastically better from that standpoint. And now we have positive momentum moving in that direction. And I think we're always like pretty smart about our processes, but this has caused us definitely to shake it up a lot, which is great.
Yeah, that's great. That's great to hear. I mean, always, it's been so hard to get through these strange times, I think, for a lot of people. And so to have some, cup half full, silver lining moments in anyone's company, I think is great.
Yep.
So thank you for sharing that. I do want to open it up real quick. I don't see anything in the chat function from the Zoom session, but I did want to generally open it up. If people who are in attendance do have any questions for Brendan on his presentation or any mortgage questions you might have, you're welcome to unmute yourself and ask. Brendan, would it be okay if we shared your email with people in case they want to get in touch with you? How can they get in touch with you if they have questions maybe after the session?
Absolutely. It's bmckay@mckaymtg.com, and I think it was on this one right down here.
Perfect. All right. So it doesn't sound like anyone has unmuted, but so then I just want to, again, Brendan, thank you so much. This is super interesting and helpful. And, I'm not necessarily in a position to move or buy a house, but definitely had some good nuggets in there. And cool. Just wish you and McKay Mortgage all the best. Thank you so much for joining us. Again, thank you all who are in attendance for joining us. This will be posted on our Make Anywhere SharePoint. So Brendan, again, thank you so much for your time. Again, if people have any questions for Brendan, his email is bmckay@mckaymtg.com. Brendan, thank you so much for being with us. Thank you all for being with us over Zoom. And everyone, if you have any other questions for Make Anywhere, if you have comments, questions, concerns, suggestions, jokes, you can email us at virtualcommunity@makeoffices.com. Awesome. Until next time, everybody, take care, and we'll see you next time.
Thank you.
Bye, Brendan. Thanks so much. Have a good one.
You got it. You too. Bye.